Welcome to Minus 20, the journey of an independent food business.
Hey folks, welcome back to Minus 20. I'm Walter Biscardi.
And I'm Keith.
And today we're going to be talking about financing your dream. You know, you're ready to start a business and now nobody does it for free. You got to have some money to get this thing started. Keith has started both restaurant and food manufacturing. So let's start with, first of all, you were a chef.
Yep.
How did you learn about raising money, raising capital?
Interestingly enough, got my undergrad while I was a chef. I finished up my undergrad while I was a chef in business management and economics. Went to business school, grad school, got my MBA, and still left having no ungodly idea about how I raise money for my small thing.
Okay.
And in my infinite naivete,
and it is infinite.
Infinite, was told by someone, and I won't call them out because it would be embarrassing,
Sure.
who was a PhD level college professor, who said to me, "You can't go out and raise your own money unless you're going public. It's illegal." And I thought to myself, that is the most ignorant, irrational thing I've ever heard. I don't think that's correct.
No.
I'm certain that there has been private money raised to start small businesses along the way.
Yeah.
Unless everybody's breaking the law and the government doesn't care. I'm going to call the SEC.
Okay.
So I called Washington, D.C.
You did? For real?
I'm so embarrassed to admit this. So I called the SEC hotline and said, "Hi.
Hi.
I just graduated with my MBA." And they were like, "Well," which they should take it back.
Yeah.
And I'm under the impression that it is perfectly legal to raise money without publicizing that I'm raising money, without
Going public.
Right. Well, without going public. Like it's perfectly okay for me to knock on doors and go raise some money.
Yeah.
And the person said, "First of all of this is on our website, sir. But I'm Gen X and not millennial, so we still know what a telephone is and want to talk to people." And I'm really embarrassed. They said, "Just go file Reg D, sir, and don't waste my time again." Thank you.
Thank you.
Now, I didn't know what Reg D was.
Okay.
I went to the SEC website. And it was interesting because they said you can issue a private placement memorandum, which I didn't fully understand what that was. We didn't talk about that in business school.
Okay.
And raise money from accredited investors, and I didn't know what that was. An accredited investor at the time, I think, was someone with an income of over $200,000 a year or net worth of over $1 million, right? So the government is trying to keep small business owners, emerging entrepreneurs from raising money from little old ladies on fixed incomes,
Okay.
right? You have to go to someone who knows what they're getting into. And if you do that, that's okay.
Okay.
And you don't have to publicize the specifics so long as you file an exemption under Reg D, right? And today there are more, I think there's Reg A, Reg D. So go find old Reg D and it will point you to new Reg A. And effectively what you do is you tell the government, "I want to raise X amount of dollars. I promise to do it from accredited investors the legal way. And beyond that, I'm not filing any other disclosures because it would be a waste of government time for such a small business to have to go through a complex regulatory process."
Okay.
I was raising well under $1 million at the time. And so did that. Went and was able to do it, by the way, all by myself, right? So too often, small business folks, emerging entrepreneurs go out to these services that charge you what seems like a very little amount of money, but zero is better than a little amount of money. It cost me nothing to file Reg D, right? It cost me very little to go find a template for a private placement memorandum. and read through it and cut and paste company name A and industry activity and disclaimers, and then do that legwork up front, and then for $100 have a lawyer look over it for 3 minutes and go, yeah, this is fine. and then we raised money. And so that private placement memorandum forced us to network one-to-one with folks. You can't put an ad in the paper, a headline. You have to go network really discreetly. So effectively, you can't publicize it. You have to go network your way to accessing capital. And with the help of some really smart people from my business school environment, we're able to do so.
Now, what kind of business was this? What were you raising money for?
So we were raising money for High Road.
So this was for High Road.
That was the first time that I had ever raised capital the right way without just borrowing money from a family or friend and saying, I'll pay you back, and keeping it super informal. This was the first time I had ever formally raised capital. So we are a C corporation, so we went out and sold stock in the company.
Wow. So you literally learned how to raise capital through the SEC.
Through the SEC phone person yelling at me.
That's great.
Yep.
So, and this is great. So you were raising money to start the original High Road, which is a food service business, obviously. Ballpark it. Let's just say somebody wants to start an ice cream company. We talked about a barbecue sauce company. You have any, for food service manufacturing?
Yep.
Ballparking it small.
Pilot, 100,000. Get in the game, $500,000. Be able to scale to $1 million in revenue, $1 million.
Okay. So
general ballpark depends on what you're making. If it's a raw meat product, totally different game. Dairy will be, anything highly regulated will be slightly more expensive because your equipment will be, have to be of a certain grade to do it properly.
But just to give you guys just ballpark thumbnail, 100,000, $500,000, million.
I think it's a great way to, earmark or use Excel and say, okay, I got $100,000. What can I do with that? And pay myself a little bit, right? What's your baseline? I live in a studio apartment and eat Cheerios for the first year kind of budget. Make sure you earmark a salary for yourself. Too many entrepreneurs don't. And it becomes frustrating, and it's hard to run. It's hard to be creative when you have a poverty mindset, when you're broke, right? So you have to at least eat. Yeah,
to at least have a little salary for yourself.
Yep.
Cover your costs, at least.
Inexpensive groceries and thrift store clothing, man, and then take it from there.
So let's talk through a few. So let's just say you're starting off with that $100,000. You get $100,000 to do that pilot program. Great place to start is what a lot of people call that friends and family.
Yes.
You try to raise it there. So what are some of the, obviously it's great because you know the people, but what are some of the pros and cons to think about when you're getting into friends and family?
Well, the odds are that you're going to light their money on fire and never return it to them. So this has to be money that they don't need. They have to look at you in the eye and say, I'm doing this because I love you and I support you. And while I'd love to make some money someday, I am considering this gone. And if they can't do that, don't take the money from them.
Wow.
If it can't be a quasi-gift, right? If you're going to put family member through pain and suffering financially, don't take their money. Don't. Okay. Even if they want to, please take it from me. I believe in you so much. I really have to get this back by next Christmas. Don't take the money. Right? Yes. My mother and stepfather have always been willing to step up and be all in with me. I don't come from a very wealthy family, but I come from a normal upper middle class family, and they're always willing to go into that earmarked money that, take it or leave it, their fun money, and here we believe in you, and it's more a gesture of we believe in you than here's sufficient capital to run a multi-million-dollar company. It's just we're in, kind of like a parent paying for their child's college, like placing a bet on you. please take care of us when we're in our final years.
So just straight up gut check, honesty.
Yes.
If you're taking money from friends and family, they need to understand they're never going to get it back.
And you're likely to fail, right? And you're likely to fail, and that failure is likely to be painful and embarrassing, right? So all of that has to be on the table up front. And I would also say that you have to be ready and willing to fail. And if you calibrate yourself in a healthy fashion against that fear of failure, you tend to be more frugal. Like you should be terrified of screwing it up, right? Like, all right, I know they said this money doesn't matter to them, but I would feel like a champion if I tripled their money, right? And if that's the kind of stuff that motivates you, right? Like I'm gonna wake up in the morning and work for mom's return every single day, and that the day when she least expects it, I'm booking a NetJets flight to Barcelona, and we're gonna drink cava all day long, and she's not gonna know what hit her, and I'm gonna return the check to her on that flight. Like, if that doesn't pump you up, seek cash elsewhere, right? Seek cash from more dispassionate investors then.
Okay, well, that kind of leads me down to the next path. So investors, what I affectionately call the good, the bad, the ugly. And one of the big things is too, like, who do you even trust when you get into that game? So advice for going down that path with investors, finding investors.
Bobo move number one for new entrepreneurs is the desire to cling on to majority ownership of your business.
That's not going to happen with investors.
It's irrational to expect that's going to happen unless you're Mark Zuckerberg, and you're not Mark Zuckerberg.
No. So
right?
Brand new, you've never started a business before, not going to happen.
And by the way, the investor is protecting their downside risk, right? And so if you're just getting to know somebody, they want to be able to put someone in your place. Maybe they believe in the idea and the concept, but you're irresponsible, or you lack the proper managerial skills. Like, something might happen where you figure out you don't like running the business. The investor community should have the right to retain some power, authority, influence over the move forward of your organization. And if you don't like the feeling of that, then raise money from friends and family, or save more money and own 100% of your business. But if if you have aspirations to grow something, you're going to need an advisory group. You're going to need people who are financial experts by your side. And typically, investors have expertise with cash. And so there are different flavors of investor. For a typical startup food business that's trying to get to its first million, there are either seed capital incubator type organizations that oftentimes are built off of large consumer products companies. So General Mills, Unilever, Nestle, I believe, Mondelez, and on, have all built incubator, Chobani, have all built incubator investment vehicles to help start new brands.
So they're helping to incubate new ideas.
Yes.
And with their money.
Yes, and it's one in many that get the investment. Your timing has to be good. The industry that you're going after has to be good. Chances are you have to be kind of on the front, on the leading end of a trend, whether it's better for you or plant-based food or snacking. These kinds of things tend to pop up every year. Or it's just a radically inventive twist on something that already existed, a la Kind Bar. When Kind Bar came to market, it was a big deal, right? And so Starbucks has investment arm. They do. And so there's that. Those are hard to land. You better be a really good pitch person, and your product better be extraordinary. The next tier are what they call family offices, right? So these are high net worth families who are folks who want to ensure generational wealth for their families, and also deploy cash based on their family's priorities, right? And so if you made a significant amount of wealth in the food business, it wouldn't be uncommon for a family office that got wealthy from being in food to invest in other small food businesses.
Okay.
Right?
Any examples of like who would be a family office?
So your wealthier families have family offices. I would imagine that the Walton family that owns Walmart has its own family office. I know that from the Collier organization, they have their own family office. And so if there's a name associated with a multi-generational, multi-billion-dollar type of business structure, typically there's a family office that's been spun off of that. Now the challenge with that is they're not out there broadcasting for you to call them, right? So I'm pretty sure that Alice Walton is not going to get on Instagram and say, hey, all you people who want to start up a business today, give me a ring, right?
Not even on LinkedIn.
It's very, very discreet, but there are small investment banks out there. There's entrepreneurial organizations. Again, there are fellow food entrepreneurs who oftentimes have some kind of connectivity to family office investors. You'll have to pitch, and it'll be 100 calls before you get one person interested. And so you have to be absolutely unequivocally immune to rejection, because most will tell you, I mean, we have been meh to 1,000 people easily over the course of the business. Keith, we really, we like your business. Congratulations on all your success. But here are the 19 ways you stink, and no thanks. And
those are the ones that respond. There's like 500 that you don't even
correct
answer the phone.
And by the way, when you get the feedback relative to the ways that your business is not attractive to investors, that is not the time to go home and go, my business is bad and I work hard every day. And no. Yeah. Write down all the feedback that they provide to you. Go look at yourself in the mirror. Go look at your business model. Go take a look at the colleagues that you're running the business with every day, and gut check. Do you have the right partners? Do you have the right capital structure? Are you working with the right bank? Are you working with the right distributors? They're probing as a means of helping you. And honestly, sometimes, actually every time the feedback is more valuable than getting a yes on the investment. Because if you're tenacious enough, eventually you'll attract the investment.
Oh, absolutely, absolutely. Now we could talk for days just on investors and all the pitfalls and this, that, and the other. There are just a couple of little red flags. 'Cause obviously, when an investor says, "Keith, I love you. I'm going to give you $1 million," there's going to be like a book that gets slid across the table that now you're going to start signing, and all this is after negotiations and everything that's going on. Can you just give me like maybe 2 or 3 red flags that you either hear, that you see, that you're like, maybe this is not the investor that I want to go with?
Yes. If they don't provide you a formal term sheet, that's a red flag.
Okay.
If they don't provide you a semi-formal indication of interest or an IOI, so you'll hear terms like IOI, LOI, letter of intent, term sheet, to socialize what the investor is thinking relative to their investment in your company, right?
Okay.
Then you'll start to hear about preferred versus common.
So let's just start. So the letter of intent, I mean, what is that? It basically says, Keith, I think I'm going to give you $1 million, and this is what the terms are going to be.
I think I might want to invest in you, and our initial thoughts based on the information you've given us is $1 million with an 8% guaranteed coupon and 2x our money guaranteed after we pay back the senior lender, and here's what the waterfall could look like if we exited at X price.
So it's basically like the life cycle of the investment, just in a sheet, a little outline of what the life cycle of the investment is going to be.
Sure.
And you want to see that.
You want to see that. You want to see the general terms of what you're getting yourself into, because oftentimes the investor will almost always structure so that they are as close to guaranteed to at least getting their money back as possible. And so if you don't execute as the CEO or entrepreneur, there are odds that the investor will get their money back and you will get nothing. And so that's important. The investor is not interested in splitting with you. The investor is interested in investing in you such that you exceed your stated plan by many multiples, and then everybody is happy.
Sure.
But when you don't meet plan, it's where the investor is disappointed but just gets their money back, and the entrepreneur chalks it up as a fail.
Okay.
And by the way, there's nothing wrong with that at all. In fact, it's important. Entrepreneurs should fail, bounce back, learn from that experience, go raise capital the next day for their next idea. Right? It is too often, and I did it myself when I failed the first time, is I went and buried my head in a hole for a decade before I got back in the game again. And that's one of my great regrets in life, is that, look, I'm entrepreneurial, I'm gonna miss from time to time. And I thought that miss was a referendum on who I was as an individual. Wow. Like, you're less than worthy, you have no business opening a business, just go get a job and put your nose down and work hard. Maybe you're not the rock star you think you are. And went into like this 10-year hiding. Wow. And it felt terrible, right? And then going to grad school helped kind of draw that back out of me again. But there was a worthiness issue post-failure that was deeply unpleasant.
Wow.
Yeah.
Wow. So any other red flags? We talked about just pressing, but I mean, I know there's so many things. I just want to kind of give them a couple of things just to...
Yes. Nothing should sound loan sharky or weird, right? The nature of a conversation with an investor is very Q&A oriented. It should sound like the investor is curious, supportive, again, just much like friends and family, able to lose the money, right? This isn't their primary source of income typically when folks are investing at the angel or family office level, sub $10, $20 million. This is, I don't want to call it fun money, but it's more adventurous, high risk type investing.
Okay. So on a basic level, for those people listening, watching, who are raising capital, raising funding, it's easy to say, hey, I'm going to get an investor, I'm going to raise $1 million. Okay, Keith, you've got that $1 million. Now, what does this actually mean? Because the investor didn't just give you the money. What does that financial distribution look like that I'm expected to provide at the end? Because getting that $1 million is nice, okay, I can buy my equipment, I can get the building, I can get a staff, but now you've got $1 million over your head that needs to go back to the investor. What does that financial distribution, that payback look like?
Well, it varies dramatically, and it's very important to ask the investor at the point that you're socializing with them what their expected time horizon is. So a family office might be very patient. They may say, I don't even need this money in my lifetime. This is going to, I'm going to pass this down to my children, the next generation. So if you stay in the game for 20, 30 years, I'm not going to be knocking on your door for cash so long as the company continues to grow in value.
Okay.
So that's that's a rare investor.
I was going to say that must be rare.
But it's real.
Okay.
And then there are investors who are in the 7 to 10 horizon, again, in terms of years, and that tends to be an angel type investor. Okay. And then your private equity incubator, typically 3 to 5, and we prefer 3, and this is how fast we need to move. Okay,
so let's just use that one. So 3 to 5, that's the money you've got. What does that mean? In 3 to 5 years, what am I expected to provide? I know there's a lot of scenarios, but a typical scenario in 3 to 5 years, what is that investor expecting to get from me?
The investor expects to, the investor may reserve the right to force a sale of the company at year 5, right? So at that point, what the company will sell for whatever the company is worth, and the distributions will cascade according to the parameters of what are often referred to as the definitive documents.
Okay.
So after you go through the term sheet process and you go into due diligence and the company or individual says, I'm going to invest in you, your attorneys then work on the definitive documents. And the definitive documents outline all the terms of the investment deal in the company, and if the investor has the right to force a sale of the organization in year 5, say.
Okay.
They market the company, put it up for sale, and distribute the funds accordingly. Now, if you're upside down, right, meaning the company sells for less than the invested capital, the investor takes 100% of the proceeds minus the senior debt.
Okay.
Okay. In a situation where it's been a success, the investor gets their money back, plus the agreed upon return, and the rest of the money goes into what's called a waterfall.
Okay.
Which I love that term.
Yeah, that's fun, isn't it?
Yeah, especially if it's a good day
If it's
for the
raining money,
right,
yeah.
right. So in that waterfall is basically what's referred to as your cap stack, right? So these are all of the investors in order of what you call preference. So you might have sold some preferred stock, so it's the preferred stock plus their dividend followed by the common stock. And that all just cascades through based on the percentage of the company that those investors or management team, folks who have earned in equity, and where they stand on that waterfall.
Okay.
Or in that waterfall, I should say.
Okay. So that's one option. In 5 years, you have to sell. What if they don't force you to sell? And now you've hit that 5-year mark. Is it kind of similar, just without the sale?
No, nothing happens to the money at that point. It just stays as equity. It's kind of like when you buy a stock through E-Trade, right? If I buy Coca-Cola and hold, it's just there.
So the investor is just simply holding their percentage of the company.
Yep, they just hold.
Okay.
Now they can get diluted. So oftentimes, as companies move on, the nature of their business changes as they shift and adapt to marketplace conditions, and so it is not uncommon at all for companies to go out to market to raise more and more and more and more capital, which ends up being very frustrating to the sort of uninitiated common stockholder because they get what's called crammed down or diluted. Meaning new money comes in, that new money is usually more it comes from more sophisticated funding sources like private equity firms, and they advocate for significant preference for their money out because of the sheer force of the amount of money that they're able to invest. So a PE firm that could come in and invest 20 million is going to be able to force more rights, earn more rights, demand more rights than your uncle who flipped you 20 grand to help get the thing started, right?
Okay.
And so it's important, again, to keep the early investors abreast of what's going on in your business on at least an annual basis. And then understand the word accretive, right? So oftentimes accretive, A-C-C-R-E-T-I-V-E. So if the pie is getting larger, right? So if let's say when you invested back in 2010 in my company, I gave you 10% of my business based on the valuation at that time. And then 10 years later, you own 1% of my business, right? An uninitiated investor might be, what the hell, Keith? You know, you took my money and now I only have 1%. Yeah, but you have 1% of $100 million entity that was able to exist because someone came in and invested 20 or 25. And let's talk about this in dollar terms. Your 20 grand's worth, I don't know, let's guess, 120 today. Oh, cool. Keep me posted. Looking forward to talking to you next year. Right?
Up to date of what's going on.
Yeah, so it's dollar's more important than percentage all day long, even for you as a founder. So I own less and less and less of a percentage of the business over time as I take on new capital. With that new capital comes new intellect, new ideas, right? New power, new prowess, oomph. a better board of directors, more moxie in the marketplace. It's actually fun to be a minority holding shareholder of a more powerful organization, so long as your board of directors and investors want you to keep doing what you're doing. I could get fired.
And we're laughing about that. Yeah,
well,
okay.
I'm working very hard to,
yes, no, he is working very hard.
Get fired.
The board of directors is actually going to be a great discussion in the future.
Oh, yeah.
Those together.
I think that would be a good podcast.
Any last thoughts on just the basics of raising some capital for somebody who's never done it before?
Yes, investors are not money hoarding horrible people. They're usually wonderful people who have worked hard. Sometimes people fear investors. There's nothing to fear in an investor. It's exciting for someone who has the capital to deploy it with and on someone who they believe in, right? Mm-hmm. Really, what's better than seeing a fellow human being place a bet on a person? That's cool. So much cooler than buying some stock or putting it in a CD or going to Vegas, but to say, Walter, I'm placing a bet on you. And, it's going to require, a phone call every Monday at 4 o'clock for a check-in, and I'm going to be on your board of directors. I am an enriched human being for being given the privilege to steward other people's money. It's really cool.
That's pretty cool. It's pretty cool to watch the company grow and do what it's doing. So I think that's a good little primer right there for those of you making your first steps, and I really hope you all do, making your first steps as an entrepreneur in the food business or whatever business you decide to go in. That's pretty cool. So for -20, I'm Walter Biscardi.
I'm Keith.
See you next time.
Thank you.
Thanks for joining us here on -20.